Hello, this is Luke McCarty with McPherson Financial Group. Thanks for joining us on our YouTube channel. This is going to be the third quarter of 2022 update. It's going to be a couple of weeks late as we were waiting on the CPI data for inflation to print for September. So we're going to start with the update on what's happened in the past, and then kind of talk about, our thoughts on what we see in the future, as well as, what this most recent inflationary number that came in pretty hot kind of means for the markets and your accounts. So when we start looking at annual performance, this is through September. So when you look at this, the bold numbers on the far right is our performance. The gray numbers are the benchmark. So looking at this, our models outperformed the benchmark in every one of these except for our individual stock model. And that's just a component of basing off the S&P versus where we have some NASDAQ assets in there too. The NASDAQ is down over 30% through September. The S&P is down closer to 25%. But looking at this, our covered calls still doing extremely well. And then our equity income balanced has still been our best account this year so far. And that is a 50% stock and 50% bonds. So if you look at that, where the stock market's down 25 to 30%, bonds are down 15, this account's down 10. It's well outperforming the market in a historically bad environment. When we look at kind of our ETF and mutual fund accounts, you can still see similar trends where our most aggressive accounts underperforming a little bit, and then every other model is outperforming, except I'd say for municipal income, which is probably right in line with the benchmark. When looking at this, our multi-asset income, if you go kind of two to the bottom, right, that's your bonds. See the bond market through September down 14%. It is down lower now. And so it's just been a historical bad year for bonds. And then, add that into, the stock market doing bad as well. And that's kind of where we sit so far for this year. Our economic indicators, so they are still pretty good. Housing has kind of fallen off a little bit with rising interest rates. I've seen mortgages in the 7s now. Real personal income is negative because, if you don't have an 8.2% increase in your wages, you have less money. Retail sales is still doing really well. Civilian labor force, this is unemployment. So a couple of weeks ago, there was some news on a Friday where the unemployment rate dropped to 3.5%, and the stock market went down with it. So we may be in a new environment where good news on the economy is actually bad news, because that could give the Federal Reserve a longer leash and allow them to raise interest rates faster. They are anticipating, the Fed, of job loss and higher unemployment to help bring down inflation. And this one's still really strong. So this is a new negative of the economy, is the civilian labor force. Industrial production still holding well. As we're almost, fully employed. Of course, industrial production's good, sales are good. But the housing market, we see some concerns. We have clients, who are realtors or builders or, within that industry, and they're seeing a major slowdown. All right, so here's where inflation printed this week. So October 13th, inflation printed at 8.2%. A week ago, so the Federal Reserve of Cleveland comes out with their estimates. A week and a half ago, they estimated at 7.7. Last week, they revised it to 8%. It came in at 8.2. So things came in a little hotter than expected. Still down from our peak of 9.2, but you can see here on this long trend of inflation for the last 25 years, we're still extremely high. Here's how some of those numbers, not the calculation, but here's kind of the price increases. You can see, of course, fuel oil up 58%, gas utilities 33%, food at home 13%, food away from home 8.5%. The food at home, that'd be more like, going to the grocery store. I feel like it's more than 13%, but I guess this is price increase since last year. Used cars are coming down a little bit now after all the rental car companies, kind of flooded the market and sold off during COVID, and things were, they couldn't buy new cars, so there's a new car shortage. So used cars are coming down. Shelter at 6.6, that's the one we kind of see increasing going forward. As a part of the CPI component, a lot of it is rental rates. Well, rents, usually you don't raise rents on a monthly basis. You have a year over year contract typically with if you're renting a house or renting an apartment. And so that's what's going to put a lot of pressure on us going forward as those rental rates renew today, from last year. If you signed a lease in October and you have a new one this year, it's more than likely going up. And so these are some price increases from the CPI report that came out this morning, October 13th. Here's kind of the expectations of the federal funds rate. I mentioned this in our last video. The gray line in here is what the federal funds rate actually is. And, the green dots on the far right are the market expectations. And then the blue line is the FOMC. So the open market committee is their year-end estimates. This has continually been going up. Every time we look at this, it feels like from JP Morgan, those estimates are going up. The anticipation for this year before today's CPI report was to increase by another 1.25%, kind of get us to the 4.5% range. We may be getting closer to 5% now by the end of the year on the federal funds rate. From a personal perspective and from a economist perspective, I think there are other ways we can slow down inflation than just raising interest rates. It seems like this is the only trick in the bag they're using now, and hopefully they can slow down at some point and not cause a recession. Because when you see this chart kind of going up from a stair step perspective, it tends to fall down really quickly afterwards. And when you look at the charts here, that the big jump here is the tech bubble, far left. Then you have the subprime mortgage crisis, right? Then you have 2018 and 19, and then COVID. So we're seeing it going up extremely fast right now. From a market perspective, this is a good chart to look at the S&P 500 history. If you look at all the blue on the right, that's every year since 1926, the market was positive. So 71 positive years versus 25 negative years over 96 years. So your average return is about 10.5%. Currently, we sit very far left, second box. It's not in there because it's not the end of the year. But if we finish down, call it 25, 30%, we're going to be in the very far left of the historical almost 100-year rate of return on the S&P 500. So this could be a historical bad year. But this is a good way to put it in perspective of how the market is typically positive, and more often than not, you're in the blue or you're, kind of towards the middle, but we are very far left on this chart right now. Here's another chart that's pretty busy, but I want to show you this. This is your traditional 60-40 portfolio. So 60% of your money would be in the S&P 500 and 40% would be in a 10-year treasury. Here's the kind of the return since 1928. We're sitting right now through September, down about 21%. I said the market on a 60-40 portfolio. That could be the worst year since 1931 and the second worst year, since 1928. I mean, these are historical bad numbers in the markets. And so, we need to see inflation come down. We need to see the Federal Reserve slow down. There's a lot of things that could help, change this outcome. And it doesn't seem like we're heading that direction at this moment. So given, saying all that, here's some of our concerns. So the blue is the federal funds effective rate and the red is the consumer price index, or CPI. So every past tightening cycle since the 1950s has ended when the federal funds rate was above core inflation. Core inflation is around 6.2%, and the market has only priced in the federal funds rate at 4.5. So currently the federal funds rate's 3%, but what's priced into the market's about 4.5%. We think that's going up. And so we're going to need to see federal funds go up even more than expectations if we look at how things have been historically. So just to recap, right, we need federal funds rate above core CPI in all past inflationary cycles, and we're still far from it. Another concern here, is that, typically you might hear that, when the Fed raises interest rate, it leads to a recession. Not all the time, but 100% of the time, when the Fed hikes rates and the food and energy CPI are greater than 5%, we have a recession. Well, food and energy hits 22% this year. So we're on the far right circle. You can kind of see here the other circles are when, food and energy CPI were above 5%. The green highlighted and followed by that green line at the bottom and the four arrows are the four times the Fed hiked and did not lead to recession because we didn't have a spike in food and energy prices. So not all Federal Reserve rate hikes lead to a recession, but historically, all Fed hikes while food and CPI are greater than 5 is a recessionary signal. Here's another one we like to look at. It's called the Buffett indicator. So Warren Buffett looks at this. It's using the Wilshire 5,000, so the 5,000 stocks. And it's a metric showing us that stocks are still overvalued even with this most recent dip in the market. So when you think of, how much further could the stock market potentially go down from here, because it's already down quite a bit this year, an historical amount. If you just widen out and look at a bigger picture, it's still seemingly could be considered overpriced. And I think a lot of this is from 2009 and 10 all the way up through this last year, 2021. We've had very low 0% interest rates. So this can always change, of course, at any moment, but this is a bigger picture of the value of the stock market, aside from your price to earnings ratios. All right, so what are we doing differently, right? We've made a lot of changes this year. Most recently, this last week, we added in more of a hedge strategy fund. This is how that fund has performed over time in the green versus the S&P 500. You can see down there through September, the year-to-date number for this fund would be up about 6%. It's currently sitting closer to 10 or 11% on the year, where the S&P through September was down 23. So of all of our moves that we went from growth stocks to value stocks to cash, then we got back into the market, before, Jerome Powell came out and Jackson Hole and was saying, hey, we're willing for you to lose your jobs, and just kind of spook the market. And the market's kind of been down ever since he said that, along with inflation being up and interest rates going up. So we're going to add something to the portfolio that is a little different, give more diversification. When we were looking at some of our funds that we use, this year that are, either have less risk than the S&P 500 or higher returns in the S&P, things seem to be moving in tandem, meaning our large cap funds are, down about the same percentage, small cap, mid cap, all of these funds typically do not move in the same direction, right? You would expect small cap to either outperform or underperform given an up or down market. Well, this is going to help kind of smooth that ride and give us a different return type within our models and add more diversification. Some other changes we added in just this week before the CPI report, we're going to add about a 20% or up to a 20% hedge across all of our models, and reducing our equity and bond exposure. So this is going to allow us to minimize volatility while still participating in the potential upside of the markets. So we're adding in a short ETF, meaning if the market goes down, this ETF makes money. So SH is short S&P 500. You can see in our stock and max growth, it's about 20%. Stock 65 moderate and down to the 50s is 10%, conservative 30, we put a 5% hedge. And then on the short 20-year treasury, TBF, this is in lines of, hey, if rates go up, if the 10-year treasury or 20-year treasury in this instance goes up, this ETF will make money while the bonds in the portfolio or bonds in general would lose money. So for the stock model, we added about a 5% position. All other models, we added about a 10% position. You can see here, we did not add any hedging to our equity income balance model because that model has done extremely well this year, and seems to be because of some of the components of it and the dividends, a little bit less, trending with the markets in general. So those are some changes we've made this year, and changes we've just made this last week. All right, now for some good news. So the Social Security just came out this year with the 2023 cost of living adjustment, or your COLA, is set to increase at a rate of 8.7%. This is the highest increase since 1981. So for those of you on Social Security or getting ready to go on it, you should see an increase of income coming from that. And if you remember last year, your increase, some of that was offset by your cost of Medicare. Well, this year you're going to see or next year, I should say, you're going to see a slight reduction in your Medicare Part B premiums. It's only about $5 a month, but in a world where inflation is 8 or 9, it's good to see this not going up as well. So thanks for tuning in. Thanks for listening. Once again, I'm Luke McCarty. Call our office, email me. We look forward to hearing from you, and we'll keep managing things on our side and let you know what we're doing and why we're doing things.